Hey, it's Frank. Welcome back to the show. It's Monday, August 7th. Hope you had a great weekend. What has my attention to start the week? Well, what caught my attention yesterday, reviewing the news, was reports from the IMF, the International Monetary Fund, which I'm not a fan of, rarely cite. Though they do have access to global data that I don't have access to for sure. I advocate for the U.S. removing itself from the IMF. But nonetheless, checking in on some forecasts for the Russian economy from the IMF. They expect Russia to grow 1.5% in 2023, even though they expect the Russian invasion, the resulting war in Ukraine, and all the sanctions and all that to have significant impact over the medium term. In the near term, Russia's doing okay. So the economy fell 2.1% last year. The economy is now seen to grow up to 1.5% in 2023, and they're predicting a growth rate of 1.3% in 2024. The IMF raised their forecast recently on very strong revenues, of course, coming from the energy sector and the higher energy prices over the last year and a half. Although they do expect continued drops in demand for Russian oil, and they expect oil revenues to shrink. They do expect government spending to continue, and they're forecasting a budget deficit for Russia approaching 6.2% of GDP, about 3 times the size of last year's budget deficit. And they're looking for a current account surplus to decline. Remember, Russia's a big exporter of oil, so they run a surplus in their current account. A weak picture for Russia, for sure, but not a devastating picture for Russia. We'll take some of this stuff with a little grain of salt, given that we can't fully trust economic data coming out of Russia in the past few years, and prior to that, of course, much like we can't with China, increasingly with the U.S. The bottom line is the Russian economy is not in a tailspin. The Russian ruble has been weakening over the past year or so. Of course, it weakened dramatically on the invasion of Ukraine in February 2022, reaching 125 rubles per dollar. Then within 6 months or so, it slid all the way back down to 50 rubles per dollar. That was direct intervention by the Central Bank of Russia and the Chinese Central Bank to support the currency. Since that time, from 50, it's moving up to 96 rubles per dollar. So ruble weakening, but not too dramatic. And the point I want to make today is that sanctions rarely work. The US, the United States, most Western nations have imposed sanctions on Russia in response to their attack on Ukraine in February 2022. Of course, the United States has used sanctions for decades to try to manage our geopolitical situations around the world, to incentivize leaders we don't like to change their behavior. But they really work. When I think of the word blowback, a term coined by the CIA decades ago, and it refers to the unintended consequences and side effects of a covert operation. Since it has been used to describe the same with respect to foreign policy decisions and military actions. And so as the U.S. leads the effort to punish Russia for their invasion of Ukraine via sanctions rather than direct military engagement, you can be sure many outside of Russia will pay the price, including, of course, Americans right here at home. And we've known this for a year and a half now as a result of the impact of inflationary pressures here at home as a result of those sanctions on Russia. Think energy prices. Though the economic impacts at home, for many, it will be painful and take years to recover. It is worth noting that most of the sanctions imposed upon Russia, President Putin, and certain Russian citizens are a standard variety and similar to those that have been enduring for years now, resulting from their military interventions in Georgia and Crimea. Restrictions on travel, trade, cross-border cash flows, and access to overseas money and assets account for most of the sanctions to date. They've been ratcheted up to a degree we have rarely seen in the past, with sanctions on hundreds of billions of Central Bank of Russia's overseas assets, including foreign exchange reserves and gold balances. In addition, hundreds of non-Russian companies have ceased their operations in Russia, and those that have not continue to be pressured to do so. There's no doubt the Russian economy has been negatively impacted by these actions and can in the future as well. The idea of sanctions is to make the life of the targeted persons, or populations unbearable to an extent they will, out of self-interest, apply internal pressure on their leadership to change course in a given policy action. In this case, of course, the effort is to make the life of Russians so difficult that they turn on Putin, remove him from office peacefully or otherwise, and end the invasion of Ukraine. Sanctions rarely work. Rarely is the intended outcome achieved in a timely manner, if at all. The U.S. has had sanctions on Middle Eastern countries like Iran and Syria for decades, and on Russia for years. You can add to that list Cuba, North Korea, Venezuela, Afghanistan, Libya, and dozens of other nations, even including Ukraine. Some citizens of these countries have suffered for years. but it has not caused their leaders to change policy direction. Sanctions not only hurt the targeted countries' economic outlook and the lives of the citizens of those countries, they also often hurt the U.S. domestic economy, businesses, individuals, and those of our allies. This usually relates to reduced output, lower levels of sales, lower profits, or upward pressure on prices due to rising raw material prices. This is exactly what Americans have experienced from the sanctions on Russia. Higher prices for energy and raw materials used in the production process of manufactured goods and agricultural products. With a domestic price level already pushed higher by the Fed and President Biden's policies on domestic energy output and deficit spending since January 2021, inflation rates will remain high for some time as the world grapples with replacing Russian exports of oil, natural gas, diesel fuel, raw materials for fertilizer, wheat, corn, and other raw materials. Ukraine is also a large exporter of grains, as we know, and their grain exports have been severely damaged recently by attacks by Russian missiles. Sanctions will not likely end this war. Going to war in Ukraine is not in the interest of the United States. Helping Ukraine is the best we can do. And even that's becoming suspect at this point. The mechanism to end this war is either diplomacy or, as some are considering more as each day passes, a Ukrainian victory that sends Russian troops back home on their own. Until then, diplomacy should be the focus for all involved. So far, the Biden administration hasn't engaged diplomatically to any meaningful degree. The blowback, restricted supply of energy and raw materials, higher prices, lower output, and the real threat of retaliatory cyber attacks on critical infrastructure. Remember, food and energy and related raw materials are priced on international financial markets driven by supply and demand balances and speculation. As we continue in this war between Russia and Ukraine, supported by the U.S., watch fertilizer, nitrogen, nitrates, ammonia, phosphates, potash, and sulfates, and diesel fuel prices as early indicators of ongoing food inflation, possibly resulting in global shortages. The other thing I have on my mind today is a story brought out over the weekend by Senator Dan Sullivan, a Republican of Alaska, who was briefed by U.S. defense officials about an incursion by China and Russia into American waters near the Aleutian Islands off the coast of Alaska. Within the past few days is the time frame given, no exact time given. The joint operation between China and Russia consisted of 11 ships in near Alaska's southwestern coast. The U.S. Navy mobilized 4 destroyers to guide the Chinese and Russian ships away from American waters. Sullivan was on Sunday talk shows and had this to say: "This is unprecedented in terms of size and scope of this joint naval task force between Russia and China, working very closely together. Whether you live in Alaska like I do or on the east coast of the United States, a very large surface action task force between our two main adversaries probing very closely to the United States is concerning." He concluded, "It just solidifies the idea that we've entered a new era of authoritarian aggression led by dictators in Beijing and Moscow who are increasingly aggressive." Remember, China wants to take over the world as U.S. has it today. The ships did not actually enter U.S. territorial waters, according to the defense officials. They neared the Aleutian Islands. And of course, the U.S. responded again with 4 destroyers and P-8 Poseidon aircraft to shadow the ships as well. And you can be sure we had submarines out there. And so in the face of what's happened, of course, with Russia and Ukraine, and what's happening and building up between China and Taiwan, and the increasing difficult relationship between the U.S. and China, we have to come to recognize that we have foes. China is our foe. They're not our ally. Russia is our foe. They're not our ally. They want to take down the U.S. They want to drop us down a few pegs. If you think about it, we had spy balloons over the United States from China. We found Chinese police stations in the U.S. We found out last week that China was running an illegal biolab in California, apparently supported by the California government in terms of flows of money. We've had just recently a pair of U.S. sailors caught selling secrets to the Chinese military. We are increasingly finding out about China's role in K through 12 and post-secondary education in terms of funneling money into these universities and schools through their Confucius classrooms. We have a report by the Parents Defending Education that there's been close coordination between the Chinese Communist Party and U.S. schools to establish Confucius classrooms, about 143 schools in 34 states and Washington, D.C. We have active contacts still in Texas, Kentucky, Minnesota, Oklahoma, Oregon, and Washington. So we have a real challenge on our hands when it comes to managing our foes, Russia and China, as they team up together. China wants Taiwan. China wants to knock America off its pedestal of the leader of the world. Russia, of course, wants to return itself to the old Soviet Union days. And so we have some real challenges on our hands. And of course, the Russia-Ukraine war is the first proxy for that. China-Taiwan could be the next. And one of the things we might consider as we formulate policy to manage this situation, as we continue to come close to war with Russia and potentially with China, is that if we happen to cross the lines and actually enter war with Russia and China, something's going to happen in the United States that hasn't happened since, I guess, World War II. And that is attacks on our own soil by a foreign nation. You can be sure if we were to get into military conflict directly with Russia or China, infrastructure in the U.S. will be hit. Missiles will fly from the oceans, across the oceans, onto U.S. territory. Think what would happen if the GW Bridge was taken out, how you left. All right, something to be concerned about for sure. And then lastly, of course, as always, it's Monday, so let's take a look at the week ahead in terms of economy and markets. The week after non-farm payrolls, the employment situation report, which was out last Friday, is always a quiet week on the data front. So not much going on this week, although the highlights this week will be CPI released on Thursday and PPI released on Friday. All right, let's check it out. On Monday, we have Philly Fed President Patrick Harker speaking, and we have Fed Board of Governors member Michelle Bowman speaking. On Tuesday, we have June trade balance goods and services forecast for a deficit of $65 billion. Remember, we're on a surplus in services, so the deficit for the balance of goods and services is always less than the deficit for the balance of goods only. Wednesday, we have MBA mortgage applications for the week ending August 4th at 7 a.m. as always. As usual, Thursday mornings at 8:30, initial unemployment claims for the week ending August 5th, forecast for 230,000, great number. Also on Thursday, July Consumer Price Index forecast up 0.2%, year over year up 4.7%, still elevated, not good for the Fed. And we have the July federal budget balance forecast of a deficit of $92.5 billion. Oh, what a surprise. Let's keep diving into the red. And then Friday, we have July Producer Price Index forecast up 0.2%, year over year up 0.7%. That would be good, but still elevated. And then lastly, August University of Michigan Consumer Sentiment forecast for 71 on Friday. A quick check on markets for the week ahead. S&P 500 opening the week at 4,478. I'm a believer in selling rallies in the S&P 500. We have resistance at 4,582, and we have support at 43.48. Play that range. The 10-year U.S. Treasury bond, the benchmark, opening the week at 4.10%. I'm a seller of rallies and bonds. Resistance play 4.21% and support 3.95%. Check on oil, NYMEX West Texas Intermediate. Open the week at 81.95. Watch the top side at 85.73 and below at 79.72. Then lastly, check in on the foreign exchange market. The U.S. dollar index is our proxy. Open the week at 102.31. Watch above at 102.91 and support at 190. That's all I have for you today. Always try to buy American.